Hello, my YouTube friends, and welcome back. Today is part three of a three-part series on how to invest $1 million. Today we're going to talk about how to invest at 65 years old. So, welcome from Brussels, Belgium, which is pretty cool. Weather's a little bit chilly, which is nice being from Las Vegas to have a little bit of a break. Anyway, stick around, should be a really good video. Good morning. My name is Adam Kahn, and this is Investing with Adam K. I hope you're all doing well. Actually, I'm really glad I got a couple more days in. I'm really loving Belgium, and I'm really loving. We went to Luxembourg yesterday. We're here in Brussels, where we're staying and doing a few day trips today, probably out to Waterloo. Creating memories, as one of the guys said to me, which is pretty cool. So it's been a nice trip with my family so far. Made a little bit of a move, a little bit sunnier here. Thought you might see better, but maybe it's worse. I don't know. Hopefully, it's a little bit better. Anyway, today we're going to talk about how to invest $1 million at the age of 65. It's going to kind of transition into more dividend stocks. It's still 100% equities that I invested in. I know the first one was had some Bitcoin mixed in there, but simply that's because at 25 years old, you should be taking on some risk. And I saw that way as a good way to really take on a good amount of risk without going too crazy with other things. A little bit of Bitcoin makes a big difference in your risk portfolio. So number one and number two on the list are different sectors, and but both good, strong, safe companies I believe in. One is Pepsi, and the next one is NextEra Energy. I like NextEra Energy. I think they're like the best energy play to have right now. They're the largest energy company. They're based out of Florida. I think they run a really good, tight ship. I think they're a great company. They pay a decent dividend. It's nothing crazy. I think it's around a 3% yield. But I think they run a good company and they do a good job. It's where I would want to be, and it's where I am, to be perfectly honest, in my energy play. I have some others as well, but that's one of my largest positions in energy. I think we're all familiar with PepsiCo. What I like about Pepsi as opposed to Coke, because I think Coke is a great investment as well, but I like that Pepsi gets outside of just the beverage sector and really gets into other things where they have the Frito-Lay division. They also have some fast food chains. I think that gives them a better, well-rounded position, gives them some actual ability to grow. Not that I'm really looking to grow at 65 years, but it makes me feel more comfortable that there is an opportunity there either way. Now, the other thing in this list is for whatever reason, I set different investment amounts. Each of these I put $50,000 investment in. It still all adds up to $1 million. I'm not really sure why I broke it up differently. I just did. The next two on the list that I had was UPS and 3M. Um, I've had both of these in the 45-year-old investment portfolio as well. UPS is a great logistics company. They do deliveries, which I'm sure you're all well aware of. They do it worldwide. Part of why I put them in is I do think they're undervalued, and as they've gotten undervalued, they're paying close to a 5% yield. And the reason I'm shifting towards dividends is as I get to 65 years old, I want to be using the account more than I was in the other years. So I've started shifting towards more dividends. I'm getting attracted a little bit to higher dividend yields because I want to be taking that income and being able to use it towards living because my goal is to no longer be working. So while UPS has fallen in price, their dividend has gotten closer to a 5% yield. That's really attractive as I get to retirement age. My one concern is will they have to cut the dividends? Because dividends are never guaranteed. And with 3M, they've already announced the cut that they're going to have to make. But I think 3M's gone through their transition where they should be able to get past all the hurdles that they ran into and now start moving forward, beginning to grow again, beginning to grow the dividend and continuing back on the right path. They went through a lawsuit in Europe, or I forget which country it was, but it was actually pretty ugly, where they had damaged the water system, and it became a significant issue. There was a ruling on that. They've moved past it. They've actually sold off a medical division, probably to raise some capital and to separate from that. And now they're back on the path of just being in the space they should be in, selling the products you're used to. They have over 2,000 SKUs in their portfolio. They're in medical. They're obviously the post-its that you're well aware of. 3M's pretty well diversified. I have an investment in both 3M and UPS of $75,000 each in this portfolio. So the next one here, also a $75,000 investment, is one that you guys, if you've been watching a while, know that is one of my favorite, which is Pfizer. It's one of my favorites because healthcare is pretty stable and pretty relaxed, and I also think Pfizer's been so out of favor and has fallen a huge amount that it makes it a really attractive time to be picking it up. Obviously sometimes when things are out of favor, it can get worse and worse. I just think there's a point where it's moved far enough that by virtue of the stock price falling, improves the yield, and you're in a good company that's been around an awful long time. And most of these companies that have been that long, they know how to weather the storm of different economic conditions and environments. I think Pfizer's in that category of being around long enough. And then the next one is an interesting one. It's the first time I've entered it into the portfolio, but it really is to push that dividend yield a little bit as we get into those retirement ages, which is Altria Group. Now, if you don't want to be in Altria, I totally get it. Um, some people don't like investing in cigarette companies, see it as a bad thing. I do too, so I don't want it heard the wrong way. But to me, an investment's an investment, and what they're doing is what they're doing. It doesn't mean I shouldn't be invested in it because of my beliefs on good, bad, whatever. I just, if I really am upset about it, I can use it to fight that cause if I want to. But I also put 75,000 into Altria Group. My thought process is they're paying almost a 9% yield, which is super attractive as I get into those later years. And there are only so many companies that I'm comfortable will be able to actually make those payments and continue to grow. Cigarette smoking, especially as I'm here in Europe, my God, people still smoke, a lot of them, and they're smoking at restaurants and things like I haven't seen since I was a kid, but it seems to be commonplace and not that big a deal. Now, Altria is the US version, so there's a little bit more risk to it, but at the same time, people smoke back in the US too. So I don't see that changing for a long time. It might be a dwindling or getting smaller market share, but I think it'll be okay and last a long time, at least long enough for the next 10 or 20 years for me to get that yield while I go into retirement. So the next two I have, also at a $75,000 investment point, is ExxonMobil and Virtus Infracap Fund. It's a PFFA is the stock ticker. Um, I picked them because they do preferred stock. It kind of gets me into a sector that I'm not in any other way, and it allows me to get some really nice yield. They pay close to a 10% dividend. It pays monthly. I actually have a rather large position of it myself in my account because of that. I like the monthly payments and I like the yield. And they've been around long enough that I'm comfortable being in their investment portfolio that I think they'll survive a nice long time and they'll be able to continue to pay that. And I like something being in preferred stock, quite honestly. And then, of course, ExxonMobil. I think ExxonMobil is a cash cow along with Chevron. They're paying a decent dividend. It's around a 4% yield. They've gravitated more towards stock buybacks, though, over time versus increasing the dividend. I kind of wish they would focus on raising the dividend. For me personally, I like that better either way, especially as I'm getting closer to that 65-year-old range. I'd rather have the distribution than them buying back the stock price. Don't get me wrong, it probably works out better, but I do think that the people who complain against it have some good points. It's a bit of stock manipulation. And if you're on the board or you're somebody whose bonus is based on how stock performance is, you could really use those stock buybacks to try to manipulate the price action of the stocks to make your bonuses better, which probably in turn actually hurts the buybacks. You're also aware when things are going well and things are going poorly. So if you want to be getting out of your shares, what a great opportunity to sell into that additional buying that you're creating from being the company, the people who make those decisions. If you know things are slowing down, you start buying back the stock at an inopportune time for the actual investors so that you can get out of it. it creates an opportunity for some really bad behavior from the people who are running the company. So I don't love stock buybacks so much. So the next two on the list that I have today are Johnson and Johnson and Starbucks. Starbucks I've talked about before, but Johnson and Johnson, that's the first time we brought that into the mix. Again, it's a really good company to use towards retirement age. Both of those, again, are also a $75,000 investment. Johnson and Johnson, I think you're all familiar with. They have some of the best products around. What I like about it, they're really well diversified. They're in the consumer staples department. But really, in comparison to other ones in that field, they're usually the top of the top with the names that you all recognize. Really well diversified, good companies. I want to say they have things like Lysol and Bounty, but don't quote me on it. I'm not 100% sure. I just know that they really have the best ones. I didn't look at it before I did the talking. The thing I like about Johnson and Johnson, been around a long time, nice secure dividend, should be able to continue to pay that going forward. And I'll talk about some of the things how you can use these things to create your own JEPI type of thing. I would use Johnson and Johnson if I wanted to be a little bit more active to sell some covered calls against, and maybe not on the entire position, but to try to drive a higher yield. I mean, if I really wanted to be aggressive, I could show people how to drive an 8%, 9% type of yield from a company like that. Or if I just wanted to add an extra 1 or 2% to push over the edge, you could do that as well, selling some calls. And then, of course, Starbucks, which I've talked about a bunch of times. Great brand, good company, bad information out the last quarter. Think it pushes it down to an attractive price point. Made me sick to my stomach just because the quarter was excuse me, was that bad. And on top of it being that bad, when the CEO was having their conversation with Jim Cramer on CNBC, he did such an awful job of giving some comfort of their direction as to where they're going to grow going forward and how they're going to improve in the future. His comments of blaming the customers versus some direction on how to fix things were troubling, to say the least. And as somebody who owns a good amount of the stock, I was really frustrated, not just with the quarter, but more importantly, how he spoke about their going forward plans. Like, I would like to see a plan going forward versus blaming some customers and saying they don't see our corporate value, and they don't see the what's in it for them, essentially. Kind of silly. Anyway, Starbucks, though, is a great brand. I picture over the next 5, 10 years, they'll do just fine. They'll pay that dividend, which is really important as you get into those retirement years. So the next two on the list are British Tobacco and Target. I have an investment amount on each of those is $50,000. I picture them as both being companies that should be able to pay those dividends. What I like about Target is I see their growth going forward to be really attractive. I think it's better than where Walmart is, and they're priced less expensively in terms of their price to earnings on a forward looking basis. I think it's a much more attractive company. Now, forgive me, I like shopping at Target better on top of it, but it really is also that their earnings and their projections for growth are so much better than what Walmart is. I'm not really sure why Walmart has been in such a favor ahead of Target. I also think that red circle that they're starting to do with the 2 hour delivery window and some of the other things is their beginnings of trying to compete with company like Amazon. I don't really think they'll be able to because they don't have things like the Amazon Web Services and some of the other things that Amazon has going on. But maybe they can start doing a little bit of the space to really drive those profits instead of, becoming an old stodgy company. I don't really see it with Walmart. Their projection for growth is just the online sales, which they all have at this point. So I really think they can all grow at the same pace on that end of it. I think Target's being a lot smarter about their direction with it. And then the other one I mentioned, BTI, if I didn't say it both as a $50,000 investment, but I think I did, is another tobacco company. I did that because of the yield. It's even a little bit better yield than what there is at Altria, and they are worldwide. It's British tobacco, and they're paying over a 9% yield currently. And I think they actually had recently announced pretty good earnings. I liked what they had said. In a declining market, they were not declining, and they're even showing better revenues going forward. I actually would like, despite what I said earlier about Exxon, to see them start using some of their free cash flow to maybe buy some stock back and drive that price higher as well. Since they're already paying such a high yield, I don't see them needing to increase that. But they have so much money coming in that I don't think they should keep on the books in case there's a lawsuit or something else, which happens with cigarette companies, that maybe it would be a good time for them to use some of that to buy their own stock back. That's just my thought on it. But they have good earnings. Their growth going forward looked pretty good. The stock really didn't react too much to it. I see it as an actual good investment on top of the fact that I would have it at 65 years old because it's really going to boost those yields, give some money coming in to help pay bills, and I see them continuing for at least long enough that I would be around at that age. So the next two on the list, also a $50,000 investment, is Dow, DOW Chemical, and Bristol Myers, which I know I've talked about a whole lot of the time, similar to Pfizer. I think Bristol Myers is in that same position as Pfizer, where they've been out of favor and it's driven the yield up pretty good. I think it creates a great opportunity to own a really good company that's been around a long time. And while they're out of favor, it pushes the yields higher and it turns. I mean, generally things go in and out of favor, and when they're out of favor, they're discounted. People start yapping about what's on the news and why they're not doing well. I mean, my God, I'll pat myself on the back a little, at least for now. Look at Boeing. I mean, I've been thrilled to see how it's been reacting. Now, I don't know that it'll continue. We'll see, but things get bad news. The stock gets driven lower. Everybody recites the things that they're saying into the news, why it's going to go to zero. But generally, it hits a bottom price where it becomes attractive to somebody to buy. I'm hoping that's where we are with Bristol Myers and there's not more bad news to come out. I think it's good company to own, no reason not to. And then Dow Chemical is really well spread out. They have a ton of products, and then they're paying over a 5% yield right now. Again, really attractive at 65 years old to be getting 5% return on your money and it coming every quarter. Help pay those bills and live your lives so you don't stress about what's going on in the markets. And then at $25,000 each, I had both Google and Amazon. Why? Even though they're not big dividend payers, it's really hard for me to do a portfolio without owning both Google and Amazon. They're both top in their space. It's hard for me to envision a world right now where they don't continue to grow. I mean, Google is like the blue chip of technology industry. They have both YouTube and their Google search. Um, I don't see that changing for a long time, even with the advent of AI and ChatGPT and the others. It would just seem like a mistake not to have a little bit of money in Google. And if you're fortunate enough it continues to grow at the pace it has been, even that $25,000 investment could be really good. And they actually recently added a dividend, and they have ability to raise that dividend rather significantly. Amazon, on the other hand, does not have a dividend, but to me, it's the top stock out there. Between the web services and the Prime and everything else, they've turned into such a great company. And now that they're doing advertisements on all their videos and whatever else, as a consumer, it drives me nuts. But as an investor, that's going to be what drives the revenues and helps grow the company or those sales of those advertising spots. And again, I just find it hard to imagine not having some money in Amazon and Google. Even at 65 years old, they're such great companies. Why wouldn't you want to have some investment? And it's a small enough percentage of the portfolio. If something goes wrong, it's not going to hurt. And something going wrong for those companies is not them going out of business. It's not some crazy risk. It's just a little bit of money and some growth. And then last on the list at a $50,000 investment is Enbridge. They're an energy company out of Canada. I like them because it seems like they make plenty of money to be able to pay that dividend, and they're continuing to grow. I was reading some information on them, and they seem to be in a good spot. They seem to be discounted for all the same reasons that we have. I think energy space is always a good space and is we go into a world of EVs and crypto and everything else, I just see it being more and more needed overall. So Enbridge keeps adding on to that spot. It kind of rounds us out between ExxonMobil and NextEra Energy and gives us a little bit of an addition. And they're paying over a 7% yield, which is super attractive for a company that typically pays between 4 or 5% for their yield. Again, I think it's because they've been discounted and out of favor. Nobody's really been interested in the big and boring, so a lot of them are out of favor. I think that creates an opportunity where they're rather inexpensive, paying more than they typically would in yield. So that's the whole list. Let me know what you guys think about it. Are the things I missed? Are there things that you would want in your portfolio? And like I said, I might do another video on how to turn the Johnson and Johnsons and Targets and things of that nature into your own homemade version of JEPI or JEPQ. Because quite honestly, I was looking at them recently thinking about selling monthly calls on some of it. I wouldn't want to do it on all of it because if they happen to be the stock that just runs and keeps going higher and my timing's off, what ends up happening is you own for the long term the ones that don't do well, and your calls get taken on the ones that are doing well. But it really can drive that yield up to 8 or 9%. When I was looking at 1 month out calls on Target and UPS, I saw that at a reasonable increase in price, I can make over $1 on each of the calls. That's $1,200 a year if I'm doing it monthly on a $15,000 investment on top of the yield that it's already paying on its own dividend. And then if I get taken on the stock, I've given myself a little bit of room that I'm actually going to make a nice profit on the stock in the short term. So there are ways to get that yield from those companies as well. It just needs a little bit more time and paying attention to the markets. Anyway, if you could do me a favor, if you haven't already, and hit that subscribe button, smash that like button, make some comments. I can't tell you how much it helps the channel and the algorithm. You guys all know that from everybody telling you. Appreciate the time, and I hope you enjoy your day.